Welcome to the Twomey Stock Market Report. This is James Twomey, and it is Sunday, July 31st, 2022. Let's recap a few items that are taking place in the market, what the market is telling us, what the macroeconomics are telling us, and we'll look at our table or our guardrails that we use in order to determine buys and sell and the risks that are in front of us. There's plenty of topics to cover here, so we're going to go in a little bit of a deeper dive, and we'll be able to cover quite a bit in this short segment coming up. All right, so newsflash. Well, the biggest talk is the recession update. What's going on? Well, we have in process 2 quarters of negative GDP, which technically signals a decline in growth and a recession. Bonds have inverted a couple of times and also indicates a sign of recessions. We're also raising rates. Raising rates is a way to put a slowdown on demand. We're not affecting the supply side of the equation. Supply would be, hey, let's get more product cheaper to folks. Instead, we're saying, let's make it harder to borrow money or get money to buy product and slow the economy growing that way. Hence, less spending, right? The next 2 shoes to drop. Well, the other things, and these are really holding back a major recession, or even though we all feel it with the cost of gas, housing, rent, food, etc. It's definitely hurting everybody across the board, no doubt. We're able to withstand it more so than during the dot-com bubble and the 2007, 2009 financial crash. Why? Right now, we have not seen a major decrease in hiring. We haven't seen a major increase in layoffs. So I just was reading an article today about Alphabet or Google, how they're the CEO is saying we need to get more productivity out of our workers. We've got a hiring freeze, et cetera, et cetera. They're not the only ones. High tech is seeing it first. We're starting to see a lot of during the COVID and everything else, the gig economy, people were coming up ways to reinvent themselves and probably spending a little more money on advertising on social media, if you will. And as things get tighter, and the cash flow is less, the little guys stop spending money first. Okay, so they're seeing a decrease in advertising. So people are across the board pulling in the horns, corporations, individuals, etc. How far that goes is how we're going to weather this recession. If it's mild or we get what they call a soft landing, it would be mostly because we don't lose jobs. And therefore people, even though they'll buy less, they'll be able to handle, to some extent, surviving this. Okay? The rate of inflation being at 9%, the fact that it's been on for so long, the fact that it doesn't look like it's going to abate for a while, along with the fact that the Fed was way behind in starting this interest rate rise. Let's face it, when was the last time we had a 1.5 interest rate in the last 2 Fed meetings, right? With 0.75 and 0.75. So that's pretty aggressive in the world that we've been in the last 20 years, obviously. So they're trying to get ahead of the curve here. They're supposed to be reducing their balance sheet. I keep looking for more data. I've got to do some more digging. Last I was able to find some documentation that said they actually bought $3 billion in Treasury bonds last month versus, and I thought they weren't going to buy any, but maybe they're just slowing the amount of buying and then they're rolling off the balance sheet. So more to see there. But the fact that they are buying any Treasuries means it's going to prop up the stock market. So what is really going on? What is the market telling us? Let's take globally, Europe's energy reserves and supply are depleting. That's going to affect business growth for sure. Not to mention the fact that people are going to have a hard time, heating their homes, putting gas in their cars, you name it, and just overall, where do I spend my money to survive, right? That's a little drastic, but quite frankly, so if businesses can't run their operations at full speed because of lack of energy, that's going to be a problem. And certainly the way Russia is reacting and how they're holding back on some of Putin saying, look, I need to fix, we did do some repairs on the pipeline. I can't bring them fully online because I can't get the parts because of this moratorium that's and sanctions, etc. I mean, this is all a chess game. It's bigger than you and I. But as it trickles down, that's what's going to happen. Less gas and oil to Europe. And that's going to really slow Europe. They're going to go into a major recession quicker than the rest of the world. Now, add on to the fact that we're shipping over natural gas. We've shipped more this year to Europe already than we did last year. So, that's affecting the cost of natural gas for U.S., right? As you demand more, there's more demand for your product. You're going to, go, it's on this open bidding system, highest bidder, on and on and on. We've talked about that before. An interesting fact, consumers' outlook is off 40% to a year ago, and it's the second lowest or near worst level ever recorded. But capital goods for U.S., new orders rose for the fourth month in a row. A little bit of bifurcation, as they say, one up, one down, right? So the consumer is struggling, but yet capital good new orders rose. There's a lag factor in some of this on the capital goods, but we need to look at more, and that's why I say look at the PMI. If we get manufacturing sector below 50 or below, that contraction of manufacturing, that's pointing towards recession. Less building of product because of demand. Nobody wants excess inventories to be sitting on it, a la Walmart, Target, some of these retail places. Earnings so far, 50% of the companies reported numbers lower than expected, but yet the market rebounds. So bad news is turning out to be good news in the market. Interesting. So we have to be on alert. Bond yields dropping. What does that signal? Well, we've said this before. Money's definitely flowing to U.S. from overseas. Dollar's stronger. Everybody's not pumping up. Everybody's taking sanction, and their money feels safer over here in the U.S. And they're going to ride out the storm because the U.S. seems to have the most prosperity and the backing of the full federal government, less likely of issues of problems. And, that is exasperating some of this because what does that mean? If they're easily selling bonds, the Fed government certainly isn't going to raise the yields. In other words, if I go to the store and there's plenty, there's plenty of, buyers there, I can get, I can set the price wherever I want. People are still going to buy. Well, bonds kind of go the same way. If the Fed's going to the window, you would think, hey, they don't want to pay you higher interest rates on buying that bond. So if they can sell a bond and pay only, shell out, 2.25% interest versus 2.5, they'll take the government will take 2.25. They want to pay the least amount of interest because it helps their deficit. Okay, so this is what's going on. We've got yields coming down. What is that? We've had this discussion before. So bonds are saying, hey, part of that is because people are just flooding the market with money and buying up treasuries. The demand, they're not saying, hey, I need a better interest rate in order to buy your securities. So that also, the other aspect of that is the bond market's telegraphing out 6 months. They usually look 6 months in advance. They're saying, hey, maybe the Fed's going to be reducing rates or at least not raising rates in 6 months. And the last meeting with Powell, he even said, he sounded kind of dovish. He said, well, we're going to go data dependent. 0.75 next September. We'll look at what we need to do. They're on the books for probably a half a point, I believe. But it sounds like they're going to abate a little bit, or at least not do 0.75 or 1% like they were talking about this past rate increase. And I've said this before, and if you haven't heard it, it's in a stock market when you go into a where correction is down 10%, and since we're down below 10% and we're in the 20%, we're not in correction territory. So we're well beyond that. So the market is definitely in bear market territory. It's funny because the Dow is going to be almost near that correction point at 10% if it keeps going up a little bit more, and it actually could come out of the correction territory, right? But with that said, Nasdaq is, they're all hit below 20% in the Russell. What I'm trying to say here is this: is that if the if the Fed comes out at some point in the near future and says we're going to hold back, we don't see the need to continue to raise rates, we're going to put a little bit of a hold pattern on, that typically signals the end, not the end of the recession, but a point where you can safely start in buying stocks. Now, we're not going to buy at the bottom. I've said this before. We're not going to sell at the top. We're going to play the trend so that we can get in fairly safe and get some money. The bottom line on that is we're not there yet. The Fed's still going to raise rates in September. Maybe after that they'll reduce that. We don't know, right? But they haven't called out a signal telling the world, hey, we're going to hold. So is it safe to go back into the ocean? I don't think so, but we got problems with that statement too. So the government bills or spending on this chip and inflation / green package, that's adding billions of dollars into the economy. That's a slush fund. It's a derogatory term. I don't mean it as such. I mean it that there's going to be sloshing around a lot of cash. It's akin, I've said this last segment, akin to when we did the Cold War, started with Reagan, and we put all this money into radar, bombs, missiles, military technology to cripple that, iron curtain, if you will. And it worked, but we created a lot of jobs. We bought a lot of materials from Raytheon and General Dynamics and GE, all these corporations, and they hired a lot of engineers and blue collar workers and technicians, and it was a boom. So will this be the same? Just keep in mind, maybe, but it's definitely expansion of money into the economy, and that's a good thing and it's a bad thing. If it works out that it falls on the positive side of productivity and growth, that's a good thing. If it turns out that it does not and it just becomes a draw, a down, and there's just more money out there and it raises inflation, the best way to curb inflation is through productivity. We don't have that now. The best way is to increase supply. We don't have that. We're only working on demand. Now we're throwing more money at it. So is it kerosene on the fire? I don't know. We're going to time to tell. Plus, chip. If you start a factory today, it's going to be 5 years before the first chip rolls off. So this is a long window, but you still have to hire a lot of people for research and development, and not to mention building and converting and et cetera. And ultimately, if it does work and we start this chip revolution here in the U.S. versus overseas, and we can do it and compete financially, not so bad. I think it's a good thing. The green inflation package, I don't know. We got a long way before we declare victory in that category. I don't know if by throwing money at it is going to change any iota of where we are in the technology today, and we're not going to be able to meet those green numbers that they're seeing, that they're talking about. But I guess one step at a time, right? But right now, the technology is not there, innovation is not there, materials are not there, the infrastructure. I think I said infrastructure. None of it's there to declare an end on fossil fuels, which they have declared a war on fossil fuels. So that's going to just exasperate the energy inflation curve. The dollar had a parabolic climb, is starting to slow. There's an impact to the market. We could talk further about that. All our the Dow, the Nasdaq, the SPY, Russell's all indicated buy signals back on 7/19/22 and remains intact, but they are nearing inflection levels. So when we go to our charts, we go to our guardrail technology sector, we're going to talk about that, and we're going to indicate the what ifs. I did say the end of last week, now's the time to start nibbling on a few things. We did, previous to that, buy a couple of other items and are still holding those. But this is a very cautionary time. Did we get in too late? Time to tell. Time to tell. But we've got the sell signal trigger ready to go. What is the stock market telling us? Well, the 9 and 14 EMAs across on all the indices that I just said. The MACD is definitely in positivity. The stochastics are up. All point towards gains, but they are nearing the 500 and 200 day EMAs. We'll go over, we're going to dissect a couple of charts. We're going to go into these terms a little more. Some of it's old news for folks, but it's a good to rehash some of this right now. Good learning time. The relative strength index is screaming near overbought. Typically, when it's up around 70, overbought. When it's down around 35, 30, oversold. We're in 66 on some of our indices. So if we buy, by the end of last week, it was kind of we did make some money, but it could be a short-lived gain. So the NASDAQ is really the one that's going to hit resistant levels first, and that should be the telltale sign. That was the oversold, not leaving Russell out of it. The NASDAQ got hit dramatically, and it's a very popular type purchase and buy for stock investors. And it's coming. It came back a little bit faster and quicker. Okay, and it goes down faster and quicker, but it's hitting those numbers. We're going to look at those. The advanced decline plus trend, I use that as kind of a macro, and overall the trend is now up there. The relative strength index is up there, but we're going to look at that chart as well. Commodities rebounding, that goes back to the dollar. If the dollar is just taking a breather, that's one thing, but if it actually starts abating, the commodities could start to race off. So we want to look at that as well. And we've got a couple of commodity plays now. So if you pull back without bias, we've got mixed signals. That is always scary when you're in a bear market. And don't let anybody tell you otherwise. This is a bear market. This is a bear market rally, and it's a substantial one, and it has some legs that is still left in it. But it's also one that we could all get caught with our proverbial pants down. All right, so sell buy alert, and then we're gonna hit all our charts. Okay, so you can take a screenshot of this, but we're along the die, the SPY, the Qs, and the Russell. We went via the Schwab, and XLK is not the Schwab, but Schwab SCHX. Instead of buying it up at 300, we're going to buy it, at 40 or whatever it is. So that is the broad market, more like the Dow. The SCHB is the broad market, more like the SPY. Again, we're not spending high dollars. It's more in the 30s, so it's a much more manageable buy. XLK is the NASDAQ high-tech sector, and SCHA is Schwab, and that XLK is not Schwab, but SCHA is a Schwab small cap. The Schwabs have decent volume. It's easy liquidity, if you will, in and out. These are things we can trade, but be very careful. The relative strength index is high. Usually when we start getting into the high 60s, it's waiting for a pullback, or maybe some abating is what we'll go through in our charts. TLT is, we had the confirmed buy signal. That and our other bonds, we've been in that for a little while. We used it to park our money while this buy signal came out. Not sure we wanted, our bias kind of took over. I didn't want to jump in right away on the buy side, but I wanted to put some money to work since bonds were taking off. The reverse of what we really typically see is in a recession, raising interest rates at this kind of rate is usually yields go up, and then we want to be on the short side of bond yields, if you will. But no, we went to the TLT. It's doing well. It's got a decent. We went at the SPTL, which is an index that tracks the long-term U.S. Treasury. I believe that's a Schwab one. We got Vanguard Intermediate, which is a corporate bond index, 5 to 10-year corporate bond, and it's usually pretty solid bonds. CVS and a few other, very strong companies. SPLB is more of the long-term, 10-plus year sector for U.S. Treasury investment bonds. So we've got mid-term, short-term, long-term. At SCHR, the other Schwab one, is the shorter-term 3 to 10-year Treasury. So we've got them all covered there, and some of them are 1.9 to 2.2 annual dividends. Not, if we get a few percent, which we have, it's a nice place to park your money with less risk, and we can get out if the yields take a dramatic switch. They don't move that fast, so you have a little bit of a chance. ILF is back in play, and U.S. Steel back in play. Those cross well above their 914 EMAs. We'll go through those as well. PAA is our dividend play. That's oil pipelines, sort of our commodities, oil, energy, but kind of in a safer sector. And that is up. That one pays a 9-something dividend. 9% dividend annually, and it tends to go sideways between 9 and 11 over the last year and a half. If it maintains that kind of range, it's not a bad place to park money and still earn some money. Verizon, we got took a little bit of a hit there, went below our 5.5% annual interest, so that we'd actually kind of on the negative side there, but it is starting to rebound. Did not sell it at the sell signal. I figured it wouldn't drop as far as it did, but it had that whole growth in AT&T and Verizon. None of these, Netflix, all these, they're not getting the growth. And since, when I say growth, new subscribers is not increasing at a rate where they're, so this, and typically when companies kind of go flat line like that, it's kind of, they get low PEs, which Verizon did. They tend to play a higher dividend, safe place to hold your money, but, everybody's still looking for the growth, and it's just not out there. So I guess the best thing right now is start looking at some of these. So let's look at our industries. What is the first one? We got the NASDAQ up here. This is the daily chart, right? And what's our guardrails? On a daily chart, we look for a couple of things. One is this lower chart here, the red and the green. That's what we call the fast and slow stochastic. The stochastic is usually a very quick oscillator in time. When the green line crosses above the red, that indicates generally a buy. When you get above the low 20s to mid 20s and 30, that's a good sign. And when the red, the green's above the red, that's a buy. When it gets up into the high 60s to 70s, 80s, that's, it means you're in a buy territory. But if this goes back, this one is, I made the chart a little bit bigger, but it goes back to February. If I can kind of bring it back to January 22, where the height of the market it went down, you can see stochastics came down. We had the negative crossover, but then it crosses up, down, up, down, up, down. It's very frequent. Trading on that, you're just in and out too fast. If it's a non-IRA account, you're going to get hit with capital gains. It's too fluid, but it's a good indicator. A go stoplight as a warning alert sign. You go up to we use the MACD, and the MACD is, the same kind of thing. We've got the standard MACD. What do we got for MACD? Let me, if I can get my mouse going here. MACD, where are we here? MACD. So period is 12, 26, and 9, and we take it as the close. So the oscillator on the MACD is green, and the slow MACD is red, and those are moving averages. So they smoothing data over a period of time, 12 and 26 and 9, to give you a much more of a elongated picture versus a daily up and down. The stochastic is, see how quick that is? It smooths out a lot of that data. So what do we do here? 3 things. One is I'm going to point my cursor right here, right? You see where this line and this cursor is? See how this green is below the red, but it's way down in minus territory. That's minus 10. That is, obviously down at a very negative level. The market is down, right? You can see where the actual, one of the lows. As this MACD starts moving into positive territory, we're still in -1, but the green crossed above the red, and all during that time where the green was above the red, the market's trending up. And then it crosses down below. It never really made it above 0, which is really where we want it to be, above 0. And it crossed down below. And what happens? The market drops. In this case, it dropped pretty far down, right? And then we have another crossover, the green over the red, and the market's up, and then it drops down. And then it crosses up, and then the market stays up this whole run. So it's a much better buy and sell indicator. We look for 3 things. We look for the green crossing above the red. That's the this smoothing average is starting to tell us that's a buy signal. As it gets above zero, it becomes a more aggressive buy signal, and we want to say, hey, this is a longer term trend, we want to go with it. As soon as it crosses below, that's a good time to say, let's sell. And as you can see, it doesn't, during this time, if you looked at stochastics, you've had it had a nice buy signal there, up and down, up and down. You would have been in and out 3 or 4 or 5 times, whereas here you're only once, okay? So that's really a much more indicative signal of when to buy. So now, this is a daily chart, right? The final solution is we use a 9 and 14 or 10 and 15 EMA. Now, this bronze line is the 14 or 15 EMA. Either one works, right? And then the black is the 9. So typically, what I do is I look at once I see the stochastics up above, in the 70s and above, I start getting really interested. It's above zero, and it gets into the low 20s, it gets above 50, I get really interested. I see the MACD and the green is crossed over the red. I'm extremely interested. So I'm on high alert. I'm looking at my numbers up here in the diamonds, right? I mean the NASDAQ. Well, the market's gone up, but my 9 EMA is below my 14. That's not a good sign. Smooth average means that the 14 is a longer period of time, right? The 9 is a shorter period of time. Oh, so that's telling me, yes, they are both trending up, but over the longer period of time, the market has been down longer. So that means your trend is down, right? So we wait. And as everything still climbs, we get back here on the 19th, where the 9 crosses above. It's hard to see here. Let's see if I can make it a little bit bigger. 9 crosses above, right? Now, that's telling you a buy signal. You wait a day to get confirmation, maybe 2. And then if it stays above there or even, you start adding. You can add a third. And then, every day it comes down a little bit, but still the 9 and the 14 are either touching, or the 9 stays above. You can add a little bit more on down days, right? So you start building your position. We did not do that, right? And if it kind of went sideways, and then over here, see, that's a big sideways move, right? But over here, on the 18th and 19th, we got the very positive inflection. All right? So we got kind of like the yellows and then the green. Let me get rid of that one. And then this one really took off, right? Up here, you got a little bit 4 or 5 days before, and then it took a bath, and it came up. But now we've got enough gap. That's all in. We didn't do that. My bias was strong. I said, no, we're in July, low trading, low volumes. I'm not convinced. All the macroeconomics, the energy sector, inflation, I wanted to wait for the negative GDP. We weren't that far. I wanted to wait to see if the Fed was going to raise rates 0.75 or 1. I really wanted to see what the market, the data was going to tell us. And fundamentally, companies were starting to say, hey, we're not doing as well. Things are, we're on as rosy. We're J.P. Morgan, Target, Walmart, Alphabet, Amazon, all these, Facebook. Everybody was saying things aren't as great as they have been, and we expect it not to be great going forward. So I said, well, let's let this ride a little bit. It could be just a summer rally, and well, here we are. Faced with the fact that, the end of last week, I said, now's the time to start nibbling. Now we're running into a couple of things. That's a lot of information to digest there. So let's just take a break from that. And some of the other indicators technically on a market, what do we look at? We look at the 50. That's this future, the 50 EMA, and we look at the 200 EMA, is blue. I said earlier, 66% of the market is on a New York Stock Exchange is below the 200 moving average. When the 50 crosses below the 200. That's definitely, they call it a death cross, and that was way back here. And it says, hey, boom, the market's going to go down, and sure enough, it did. And if we look at the overall trend of the market, and that's the Twomey trend track line here for the past 6 months to a year, basically year to date, excuse me, we followed it. Every time we bump up against that track line, we kind of have a pullback. Every time we bump into it on the lower track line, we have a pull up, if you will. But overall, lower lows, lower highs, and now we've got a little bit of a rally. But if you see here, right here, I don't know if you can see my cursor, but this whole section here, right around here, it's sideways action. There's a lot of buyers and sellers there. A lot of buyers and sellers. So the NASDAQ hit above that. It happened to be just around, well, before it got there was the 50 EMA. It did bounce around the 50 EMA, and now, it repelled it a little bit, and now it's using it as support, and it's headed for the 200 EMA. So all this is saying is, if it gets past these buyers and sellers here, there's not, all here was a lot of selling downward. So the upward rise is going to be a little bit less headwind. I've got a great example on one of our plays, the PAA, which we're using as, kind of a dividend play, and it shows it dead perfectly. But what I'm saying here is the NASDAQ's going to be the first because it's hit this resistance point first. So if we stay above that, good chance it's going to race up to the 200. It acts as a magnet, if you will. And if it does, we're going to go from 315 to 326. So if we're using the XLK, let's take a look at that. It already has hit the 200. Look at that. And it's, well above the 50. So, and it's above this sideways action over here in early June. So if it can get, now the 200 is either going to act as resistance. In other words, it's going to bump up against that, it's going to head down, or it's going to go above and use that as support, or sideways. Those are the three things going to happen, right? So let's see. What do we got for relatives? I'm throwing a lot at you, but it's a recap too. If you go to the earlier segments, it kind of goes into this more detail. But now we look at the relative strength in this. This is the daily chart. It's at 66. 70 is oversold. 66 is pretty darn close. Over here, when we had a high here, it was at only 63, and then it came, down. Over here, relative strength was 59, and we had a drop. Over here it was at 53, and we had a drop. So 66. I'd like to see this abate a little bit, and then maybe give us some more breathing room. We're quite parabolic between the nine. So the next support is really the 9 EMA, so that's at 138, and we closed around 144. So, this is screaming a timeout is potentially on its way. So, we went in long the end of last week. We're ready to hit the sell button. I'd keep it, I would have a tight stop here. I wouldn't, if it's, 140 is not a bad stop. And certainly 138 at the 9 EMA is an all-stop position, okay? We don't want to lose our position, especially if this races down south. It's going to race really fast. So that's the XLK. Let's look at the diamonds, and it's going to be the same story. It's bumping up against the 200 EMA. We're at 65.7 relative straight index. Alert, 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 right? And I feel like Tom Brady. Alert, alert. So we're on the fourth, higher high since the lows. Usually when you get some 4 to 6, some say 9, that's a point where it's saying, that with the the RSI a little bit oversold. I mean, overbought. Overbought, that means, less people are buying, and if less people buy, more sellers are out there. So it also is starting to, if you can see my cursor here, it's going to be this line. It was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days, pretty much sideways, and then the market came down. right? And that's where we did the same thing. We went short there last time, right? And you can see as soon as we got the sell signal, we went short and rode it all the way down. So the buy signal is over here on the 18th and 19th. We got confirmation. We did not jump in there. Um, it's being in there now. It's going to be a little bit of a risk. So we're using a SCHB, SCHX, large cap fund from Schwab. It's a good ETF. It's got decent volume. It's the same story. It's above the 50. It's above the 9. If you're in there at 48 or 48, somewhere around there, you got to have your stop at 47.4, 47.3. That's the 9 EMA. You can't play with this one. The 50. The good news here is technically now, not fundamentally, technically, you've got the 9 EMA, you've got the 50 and the 14 all acting as support. Once, as you can see, once we got the sell signal, the daily charts always were above the 14 and the 9 EMAs. And anytime it got close, it raced back up. So it's using it as what they call support in the world of technical. We've got this, if you look this bowl here, people look for this cup and ladle. In other words, they say if it breaks out above this sideways action here, you got probably going to race up. But we'll see. It probably will get up to the 200, and there we got to make a decision. But we got to be careful. MACD is really strong. Stochastics is still strong, so it's still indicating a buy. So we've got that all for the Schwab broad market, the S&P market, the IWM. Let's look at the IWM market, which is SCHA is the Schwab. See, instead of paying, what is IW? So if you go into IWM, which I use as a proxy for the Russell, you got 187, 190. But if you use the SCH index, it's a basket of small caps, just like the IWM. You're paying, low 40s. So a little bit more manageable in the pocketbook and psychologically. So we've got relative straight index here. Where the hell is it? 65. So again, high. It hasn't got up to this sideways action here. May bump up against the 200. So it could be a short bump, but we have to be careful there. Same story there. I want to go to our index play, PAAA. It bundles energy, which is taking off in certain sectors, and it's also pays a good dividend, 9 or 10 or 11%. But with that said, it's a pipeline that sends gas and oil from the, if you will, producer to the user, and it's Canada and U.S. Best way to look at this is the weekly, and if you look at this back in early 2021 to now, it's been, it kind of goes somewhat sideways. I see 8.6 there, and I see a 12 up there, and Midland, where are we? 10, 10.2, something like that. So if you're paying 10% and you get it at, I forgot what I got it at. What did I get this at? I've been adding to it quite a bit. 10.49 is my average. So, if you get 10% dividend, I can afford a 1-point loss. 9.4. We said that in Verizon, we got caught with our pants down. But so it's a good place to park money, and if you can collect 10% on anything in a year right now, I think it's a home run, right? And if it takes off, great. If it goes back, down, we're going to get out. So you got protection one way or the other. And if you stay tuned to the Twomey Stock Market Report, and once we get to the web-based model, it'll be a lot easier. You'll be alerted when something goes sideways. Now, looking at this is what I was trying to explain. See where it had quite a bit of gap down on the daily. From here to here, there's no buyers or sellers. It just gaps down from here to. So what happens here is when it starts reaching up in this area, it tends to go straight through this gap because there's nobody selling. Everybody that was up here who didn't sell are saying, hey, I wrote it all the way down. It's kind of getting close. I'm just going to wait it out. I'm not going to, I'm going to wait till it gets up here to sell. So that's the next level of resistance. So from here to up about here, which is 11.8, and what do we close somewhere around 10, I think it was, yeah, we closed at 11.04. So, from 11 to, at least 11.8, it could be a somewhat of a free ride. I don't know. We'll see. Or it could come back. But it's well above the 9, well above the 14. We got a buy signal way back here on the 18th like everybody else. So if you got a good profit in here and you've ridden this up, you want to break your money into thirds. If you were in this a week or so ago when we offered it up, you want to put a third at your 9 EMA and a third at your 14 EMA, and a third you hold on to see the negative inflection, the 9 crossing below the 14. So therefore, if we can get a little more profit, you want to raise that 9, up to about halfway between the low of the most recent high, and then the low of the most recent candlestick before that. So we're not quite there yet, but we'll raise that third up to protect our profits even more. We had a lot of selling on Friday, not a good sign for the week. Let's see, the volume was still up, but every time we get hit with a high amount of selling, we get a little bit of buying, but it continues to head downward. That was a fair amount of selling there, so we may see some abatement there. But we're going to stick with it. We're going to stick with it. What else we had? Okay, I looked at XLF. That's a commodities play. Latin America basket of funds. Commodities are coming off. If the dollar comes back and abates even further or lower, the commodities will start to race up. And if that's the case, Latin America has a lot of raw material coming out of there, and that's what this basket of funds represent. You can go on Yahoo or Schwab, and you can look it up, XLF, and it will show you what's in the top 10 holdings. I don't know if I can get that. See if I can get that here. XLF market edge. Nope. Research. Let's see. Portfolio. XLF. No, it's not XLF. Excuse me. ILF. Boy, getting these mixed up. Is the Latin America. iShares Latin America. So it's Val, which is materials. Mobil, Petro. Those are all oil based. There's bank shares. There's a lot of there's parts, even Mexico, gas and oil. So and raw materials. So it's a pretty good basket of commodities, right? So we're going to be able to take advantage of if the dollar especially abates a little bit. So we are looking at ILF and steel, okay, as our commodities, and PAA. So I just wanted to make sure. All right, so ILF, this is a better one. See, this I was showing you XLK, which is here's the ones that the PA. This is even better. Here we are at a high. Look at the gap between here and here that's coming up next. So there's not a buyer. There's no buyers and sellers there. So it's a good chance it's going to race up. And if you've held on from up here, you're going to say, hey, if it may reach back to me up here. So I'm not going to sell when it's halfway back. And then it hits another huge gap. And that brings us right to the 200 EMA. And there's another huge gap after that. So there's not a lot of resistance. It could run up pretty fast, pretty straight. And that's what this commodity-based play tends to do. It's a little bit risky, but it also pays a pretty good dividend, right? So the dividend on that is 11.5 right now. 11.5 is pretty good. 11.5 is pretty good. So, if you get 11% on your money, the problem is this doesn't go sideways like PAA or we wished Verizon did. So you've got this fluctuation you're going to deal with. 10% on 23.5 is 2, which is 25, or 2 below, which is 21.5. But, you can see here, this fluctuated between 29 and 21. That's well outside that 10% fluctuation. So it's not a park your kind of money dividend play. But it definitely has not much resistance going up there. And, we're talking about the UUP as my kind of proxy for the dollar. It's easier to watch. It did hit the relative straight index of 75, well overbought, and what happens? Came racing down. We're seeing a lot of selling the last 3 or 4 days. The MACD has crossed negative. Stochastic crossed well early, and it's down near zero. Dollar, this UUP is great because it doesn't move fast. So, and it's eclipsing, trying to fill this gap here where there's not a lot of buyers and sellers. The 50 EMA is down here. So if that comes down, it makes things, a little bit cheaper for people overseas. Right now, they look at the American dollar as very expensive, right? If you go to Europe, your dollar goes 1-for-1 with the euro. It used to be 1 to 1.25. In other words, you give a dollar to euro, and it's really 75 cents in your world, right? So they give you 75 cents on the dollar you're giving them. But now it's 1-for-1. So we're looking at that. That's a real good indicator where things are going. U.S. Steel is the other one. And this one's, even though it's a lot of high volume, it's a major corporation. I call it a cult stock. The reason why is people will play this because it's a low cost. They can buy a lot of it. And when it moves fast, and they can get in and out, right? So here, all our signs, stochastic, 0 to 75, all positive. MACD, just starting to get above 0. Our buy signal is back here on 721. So you get it. I got in. My average is, actually, I've been in and out of it a couple of times. My average is 20.33, so not bad. We're up here at 23.77, so it's up above the 50, above the 9, above the 14, and it's starting to bump up against the 200. And look over here, see where the 200 EMA is? All this resistance. These are buyers and sellers that have gone sideways for, mid-May to early June. So there's a lot of buyers and sellers there. If they did hold on and they took the elevator ride down, if they get up near where they're break even, they're going to bail, right? And some people are going to look at this and say, hey, that's a nice cup formation if it breaks out, and if it stays above the 200, that's telling me to buy. So it's going to be an interesting period of time here. So we're in that. We've been in that a little while. That's another one we have to be careful with, but we're looking at. So that's a little more detail than we want to do. The other one I was looking at is if this bill goes through, this inflation greenie bill, blank charging stations, another kind of a little bit of a cult following on that as well. Blink charging, it's got a lot of positive press. I got in that when we heard Manchin was going to flip, and if that passes, we don't know what cinema is going to do, but it all kind of indicates that this thing's going to slide through. TAN is the solar index. I haven't been able to get in that. They kind of raced above me. So Blink, I'm in. We've got our buy signal is way back here. I didn't get in then, and we'll see where this goes. But it's again, everything's bumping up against either the 50 to 200. We're going to see this resistance come into play the next couple of days, and it's going to tell us a lot. If everything bounces away from it and we start coming down, might be indicating that the rally is starting to slow down. But so we're going to have an interesting week ahead. It's coming into August. Well, 1st of August, money coming in from mutual funds. They have to put the money to work that comes in the first couple of days. And typically we might see 4, 5, 6 days after that it starts some, a little bit of selling after all the rebalance that went on. But so this is a very busy time, but it's still August. We're not into a major buy. All right, what else? GDX, there, if these is the gold miners. That's another one you want to get into. This is a tough play. Gold has really been at the bottom for quite some time. We're down at the relative strength index here. It was as low as 33 and 30.18. Definitely oversold. Our 9 EMA and 14 EMA are nowhere near telling us to buy. The stochastic is just starting to get up into the positive territory. definitely cross positive. It's nearing the above 50 areas we want to see, but it is the faster oscillator, which kind of in and out. This one is a riskier play, but it could run, and it could run up to the 50. And if the dollar continues to go down, we want to be in it. So if I look at the 120, and we'll maybe do another segment on the 120, that cross positive, these are my mouse hunts. I call them mouse hunt. You go in hunting for big game, and you often come out with just a little mouse, right? Big gains, and we end up with a little mouse instead of the big moose on the wall. But with that said, we've got the buy signal on the 120. 120 minute is what they break up the day into 120 minute bars. That kind of gives us, I look at this, if there's lows of selling, what happens? You get, you see these lows, there was some buying, and then it comes back and it hits lower lows. There was some buying and hits lower lows, right? So that's telling me the trend is still going negative. 120 minute breaks up the day into, the one bar of the day into 4 segments or 5 segments. I get maybe 3. I got to do my math better, but trying to get this out fast because we're going long here. But you can see these selling higher highs, selling higher highs, selling higher highs. So this is a mouse hunt. We're going to go in. We're going to take a risk. We're going to keep a tight stop below the 9 EMA. We'll see where it goes. It's not a lot of fast movement day to day, so you can get in, and you get a nice, if you get in somewhere, even if you get in at 26.2 and then your 9 EMA is 25.77, so get in 26.2, put it at stop at 25. You get a little bit of a risk there in the game, but really dollar dependent here. For the most part, you can see this trend. If we go to the weekly, this is gold miners. Gold miners. The miners, if gold is selling, miners are going to be busy and they're going to want to push out as much as they can. Gold itself, as the market goes for gold, that price goes up. I like to use the GDX as it's kind of a basket of gold. It's like an ETF for gold miners. I tend to look at that because if they start pumping out and they start looking good from a stock perspective, speculators are betting on it, and also they're probably shipping more product or getting more activity, and then therefore all these investment funds are looking at that, and they use that as a telltale sign that gold's going to go up. Also, gold's a speculative play, just like oil, and it's one to get burnt. I have this story one time. One guy was telling me one time, he's like, "Oh, if you were in gold, look at this. You got to buy, buy, buy." And I'm like, I had some gold, and in the stock market, I sold it a long time ago. I think we're at the peak, but I wasn't going to get in an argument over it. And it was like, put everything in, and they went over all this history and all this stuff. And sure enough, next month it would, dropped and it never stopped. So it's that kind of, play. You don't want to put your life savings in it, right? Anyways, so that gives us quite a bit of detail about our stochastics, our MACD, and our 9 and 10 EMA, our buy and sell signals. Retrospect. Should we have taken advantage in mid-July on that buy signal? Yes. Yes. Did our buyers hold us back? Yes. Timing of the market hold us back? Yes. Buying now, putting the buy signals out at the end of last week, was that prudent? I think it's going to be risky. We may get caught with our pants down, as they say. So you got to have, if you do nibble, you can always add. There's going to be plenty of time. I think we will have another abatement of the market and continue downward at some point in time. And we should maybe, come September, have one more flush out. But if we can get some points here, we will. We've got some other plays that definitely are riding. We'll look quickly at TLT. We were in TBT for the longest time since the early part of the year. Took that nice ride. Look at TLT, went the opposite all the way down, and look at it where we are now. We got the buy signal back here. This is one we did take advantage of fairly early on. I think that was the end of June. Waited a little bit, but we're definitely get in. I've been adding all along every low. I keep adding. I'm pushing up my basis, but that's okay. We are at a relative strength index of 56. We're never getting overbought, oversold, but if we can stay in the 50s there and go sideways and then pop up a little bit, I think that's a good sign. Um, some of our other ones, Vanguard corporate bond, same picture. That's raced out of the barn a little bit more. We're getting into that, nice inflection point. It's above the 50, above the 9, heading towards the 200. Relative strength index 67. Alert, near overbought. Every time we get overbought, we get a pullback. This one is fairly high for being overbought. The last one was around 59, had a pullback. The one before that was around only a 38 in pullback. So definitely some breadth there. All right, so that gives us some of our indicators. We look at fundamentals. Companies. Would we say 50% have of companies reported lower than expected earnings? A lot of headwinds out there for companies. Microsoft had bad numbers, but they said, "Oh, the future looks rosy." Kind of the first ones to say that. All right. So there's a lot of data coming at us. It's kind of conflicting data, and that tells us that means we're getting near these inflection points. We showed you the inflection points of the sideways moves a month ago. If it breaks above that, it's breaking through that resistance level. If it gets above near the 200, that becomes resistance. Watch the NASDAQ, XLK. That's at that right below the 200. If it can break through like that and then use it as a support, we might be okay for a month or so. What else do we have here? Our sector analysis table. I sorted this by the last month, and if you look at this category over here, here's the month. Number 1, information technology. NASDAQ screamed up, makes sense. Number 2, industrials. Dow's up. It's almost nearing correction territory, or may come out of it. Makes sense being up there in the last month, because that's really 7, 8. It's been a half a month there that we've seen activity. Consumer discretionary, real estate. Where's our energy? Energy is midpoint, but it's rebounded at 0.6. It was going negative there for a while, right? And then utilities, consumer staples, healthcare. These are all defensive plays. Financials, lower tier. So people are going more into higher risk plays, right? They're saying industrials are not going to slow down. They're going to be, and part of that, if you think about it, industrials with the infrastructure money that's flowing out there, if this chip bill that just passed, that's going to be more, industrial need to build, and whether it's machinery or, even R&D takes industrial equipment to get their R&D centers going. So there's a lot of predictive nature in the market in general. It looks forward, it doesn't look backwards. If we look at the 6-month comparatively, the minus 12 for IT. So NASDAQ was way down during the last 6 months. Energy was up 16, and it's only 29. At some point, we're in the 40s, right? Remember, we had CPG. Oh, CPG is the other one. I didn't mention that. I'm back in CPG. CPG is another commodity play. That one, we got the buy signal last week. We got in, and that's running up, and it could run up pretty good here. So that's another one to be into. CPG. That's gas, oil, delivery, utility, commodity play, Canada-based company, low price. So you can buy a lot of it and keep tight stops on part of it. So that's the other one. I forgot about that. Anyways, so the sector table is telling us things are rosy, things are looking good. But, right? This one, I always talk about the advanced decline for the New York Stock Exchange. They have one for the NASDAQ, etc. I look at the RSI and the MACD on this. I tend to want to picture that this is a daily chart of the advances and decline. It graphs the number of advances and declines. As the graph increases, stocks are advancing, more are advancing, and less are declining. When it goes down, it's the inverse of that. Couple of things to look. This is the daily chart in a line graph form. The blue line, that's the 50 EMA. Every time this goes back to February, so I kind of try to pull it back to a year. I didn't quite get it there in this picture, but every time I got around the 50 EMA, even though it broke above that, it was really used it, it just couldn't maintain it, came back down, used it as resistance, kept dropping. Same thing, hit there, resistance, dropped. Here, we broke above it pretty good. And, we had a couple of pullbacks, but it didn't come down at all. We can also see the 50 EMA is starting to move up in this graphical form. That's telling us more companies are advancing than declining on the daily basis, and that's a good sign. But we look at the MACD, right? That has definitely gone positive. It's up in the hundreds. Good sign. Lots of volume there. It's telling us, that's a good indicator that things are great. But now, relative strength index, again, 70 is oversold, 30 is overbought. Overbought is 70 and above, 30 and below is oversold. We're at 66. Now, if you look at 66, and I put a line up here. Basically, every time we get up near in the 60s, between 55 and 70, what did the advances do? They decline. Up here, kind of etched back, up in the highs, get near 65, 64. What happened? More declines. So we're up here at this point, and we haven't even flattened out there. It's telling us we're getting near either a breathing point where things go sideways and everybody takes a breather, which would not be such a bad thing, or we're going to have a pullback. So we have to be careful. Now, can this go higher? Absolutely. Can that 66 smooth out over time? Absolutely. So, but I looked this a little bit. This gives me a bigger picture. Okay, so that 80, that's wrong. That is not. We don't have New York Stock Exchange is 84%. That was, I meant to say, was around a low of 84% below 200. Is now only about 66%. And I've said this before. There was this, fund manager, she's very good, very well respected, and she said, they asked her about, we're down in the 80s for the New York Stock Exchange for advances decline. Isn't that telling us about it? She said, well, it's telling us things are certainly a lot. We're at lows, but the last recession, 2007 to 2009, it actually went down to 100%. We're below their 200 EMA. So, more to come, right? That was her thought. So there you go. That's the Twomey Stock Market Report. It's kind of the weekend quarterback analysis. Went to the chalkboard. We talked about some of our fundamentals. We looked at some of the technical guardrails. We looked at, buys that you should be in. And now we've got a caveat. We're a little late in these buys, in some of them. And you got to be quick on the stops. Put them tight if you're in. And if it goes up from here, you got a chance to build some capital. We parked our money into the bonds for a while. If we can get 4, 5, 6% in the next couple of months, terrific. That's something that we can get out of pretty quick versus if you bought a treasury at whatever. And then we can also flip and short the yield bonds curve. Excuse me. So what else do we look at? We looked at not only commodities and dividend plays, but we also looked at the dollar, and we looked at all our, stops signals and our buy signals. So stay tuned. If you like what you see, hit the like button, refer me to your friends. In addition to that, hit the subscribe button. As for these subscriber lists, I think you can find out that, if you go into YouTube, you'll have an alert that I've sent out a video. Some of these videos are long. I understand that. I try to make this educational. It's a little bit of sitting around the kitchen sink. It's the basement tapes, I call it. Not a lot of whiz bang, but a lot of facts, right? Some of it's technical. If you want to get into the real definitions, go to the earlier segments. Eventually, when I get this website finished, it'll have the tutorials there. And you can get into the detail yourself. More to come this coming week. I'm James Twomey. This is a Twomey Stock Market Report. Thanks for listening.